world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by Ryan Gilbert. Ryan is general partner at Propel Venture Partners, a Bay Area venture capital firm backed by BBVA. He's also, as of very recently, CEO of Olympus Acquisition Corp, a $750 million SPAC that listed on the Nasdaq in August. In this conversation, we look at why SPACs are coming back in fashion, pros and cons of SPACs versus traditional fundraising and listing routes, Ryan's plans for the future of Olympus, and more. To subscribe to the Rebank newsletter, including insights, essays, and written transcripts of all new episodes, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Ryan Gilbert. Ryan Gilbert, welcome to Rebank.
Thank you, Will. Great to hear your voice again.
Likewise. I've been reminiscing all day about the wonderful face-to-face meetup we had so long ago. Feels so long ago. It was probably about a year and a half ago in your offices. Yeah, which was great. And you know, those are the things that we don't do anymore. And I guess on the one hand, it's for COVID, and on the other hand, it's because people are generally steering clear of California if they can. And it sounds like you and those around you have kind of been staying inside. Scary times.
We have, and it's remarkable though that during a pandemic, when you lack the face-to-face interface, that the fundraising environment, particularly in things I've been involved with, can be very efficient if you do it over Zoom. So everything that we were very afraid of at the beginning of the pandemic, particularly the inability to travel and do in-person meetings, I think we've adapted quite well. It's quite exciting.
Well, that's great. And just to jog everyone's memories, you lead Propel, which is a largely fintech-focused venture firm with a BBVA tie-in, and you have an amazing entrepreneurial backstory yourself. You were on the podcast a year and a half ago, so people should definitely go back and check that out. And that that continues to be your day job and the focus of your, broadly speaking, your time and energy, right?
Absolutely. Well, I consider myself to be an entrepreneur first. I think everything that I've done has been about building, including partnering up with Jay and David and Rohit at launching Propel in partnership with BBVA about 5 years ago. I'm the type of guy who really enjoys building the furniture on day one, going to IKEA and figuring out how to use the Allen key to build the desk. That's what excites me. And the activities I've been involved in, particularly now with the new SPAC that we've taken out, has that day one feeling to it. Because we're doing new things, we're bringing new ideas, and are certainly helping to change very old established industries. So it's exciting.
Yeah. Well, this is great and perfect lead into today's conversation. So the reason I reached out to you, I guess, last week at this point was to pick up on this fantastically interesting piece of news around the SPAC, so the one you just mentioned, and based on the news that I've come across, it sounds like a $750 million SPAC, which I believe was listed on Nasdaq at the end of August, and there's just a phenomenal team around it. Yourself, you as the CEO, and then your chairwoman, who I believe is the founder of Corp, one of the grandfathers of platform banking, infrastructure banking, that really kicked off so much of what we're seeing in the world of fintech in the U.S. today. I wonder if you could just high level tell us how this all came about.
Thank you. So my partner with Olympus is Betsy Cohen, the founder and first CEO of the Bancorp. For those of us in the fintech space, the Bancorp is the enabling platform. They were one of the first banks out there that really took the approach that they were going to enable the network software-based fintech economy. And I think they've served well over 1,600, if not 2,000 companies. Many of the unicorns today are riding on the bank core rails. And they've, from the beginning, taken the approach that the bank is going to be disrupted, so why don't we help the disruption and enable the challenges, which they've done phenomenally well. Over the past 5 years, since Betsy retired from active management of the Bancorp Bank, she and her son Daniel and other partners have been running investments out of Cohen and Company, and have, prior to the Olympus SPAC that we took public at the end of August, had done 4 others involved with 2 very successful combinations, and have had 2 recently announced combinations. One is Shift Motors, which those of us in the Bay Area know very well, a new way to buy cars online, run by George Arison, very well-known entrepreneur, and also recently announced an acquisition combination pending with a payments company called Paya. And I'm just super excited to be partnering with a group of people that have transformed the SPAC world, and for 20 years previously to that's really kicked off the fintech revolution. I'm learning every single day, and having Betsy as my partner and chair of the SPAC has really just allowed us to create a global network, not only a bi-coastal network, but a global network for Olympus, supported by a very, very strong board of directors who we've invited in based on work and experience, and a 20-person strong advisory board sitting everywhere from Taiwan and Auckland, New Zealand, all the way through to San Francisco. So we've managed to really touch the planet. And that's all going to help us in our search for the right partner for the SPAC. We're looking to enter into a very, very scalable, beneficial relationship with entrepreneurs and investors who are running a special company somewhere on the planet, with a focus on continuing to grow, service customers well, and continue the journey of transforming financial services.
Yeah. All right. So for those of you and your colleagues in the Bay Area, the SPAC stuff must almost be starting to feel like, some sort of new normal to kind of parallel all these other new normals that it feels like we're now living in. But for the rest of the world, myself included, this SPAC boom, or what feels like a SPAC boom that's really kind of gathered steam over the past number of months, if not maybe a year plus now, is kind of new, or at least in the kind of venture context, circa 2020 feels pretty new. It's not a new financing concept. Maybe we can just start at the beginning. Special purpose acquisition company. It's basically a shell company that's listed on the stock market that raises funds at the time of listing, and then has the mandate to go acquire effectively, right, an operating business. And it's an efficient way of taking an operating business public with, I'm sure, all sorts of interesting benefits and incentives that we can perhaps get into. Is that a fair characterization? Is there anything you'd add?
I think that's great. I'd add a few things. The concept of the SPAC has significantly evolved over the past 12 to 10 years. If you look back a decade ago, SPAC was a 4-letter word. It wasn't efficient, didn't really have alignment with insiders, and was perhaps more of a smart Wall Street mechanism for those with capital to extract high rents out of the transaction. Over the years, Betsy and other innovators have really focused on the SPAC being a vehicle to drive alignment with the partners at the partner company. Particular alignment insofar as the promote that the sponsors get, to ensure that the promote only vests once enterprise value has been extended and expanded, much like carry in a traditional venture model. And that's why I think there's a lot of similarities between the concept of venture capital fund and the SPAC. What the SPAC drives to the partner are 3 very important things that I feel have only recently become understood by the Silicon Valley. Because of the work being done by real strong entrepreneurs and innovators like Chamath Palihapitiya with his 3 SPACs that he's done, and I think a 4th's on the way, and other VCs like me that have recently successfully IPO'd SPACs, folks like Kevin Hartz, the Eventbrite founder, who's taken a SPAC out a week or 2 before we did, and Mickey Malka from Ribbit Capital, who recently took a SPAC public in the past couple of weeks. but more and more getting into it. And the three important things that a SPAC offers over other ways of going public come down to the following. Flexible use of capital or proceeds, ability to use the capital from the SPAC trust for primary investment in the company, to have a secondary outcomes and liquidity for insiders, and also to ensure that there's a budget available for acquisitions to continue growth. The second point that I think is really important is the fact that when you combine with a SPAC, you are able, as the combined entity, to present forward-looking statements about what the combined business will be looking like, as opposed to traditional IPO, where forward-looking statements are not allowed. And if you think about startups and the companies that we're involved in our sector, it's all about the future, because we've been growing in the past. So the future does matter. Finally, there's the concept of execution certainty. You don't have to worry about IPO windows. You don't have to worry about what's going to happen the week before the election and the week after the election, because the SPACs are already public. So as long as the sponsors and the SPAC management team are able to secure the support of the unit holders in a vote when a de-SPAC opportunity has been identified and when the proxies are filed, the deal mostly gets done. And the capital, the forward-looking statements, and the execution certainty go a very, very long way. And founders are really understanding this more than anything. We have had almost 100 conversations in the past couple of weeks with investors and founders who have asked us to come and do virtual lunch and learns with them and their teams. What are SPACs about? Why should we consider SPACs? What should we be on the lookout when identifying a SPAC? And why is your SPAC different? And I think the ability to differentiate our SPAC from other SPACs is something that we put a lot of thought into during our IPO process and now that we're out there. And we focus on the essence of the partnership, that we're looking to partner with the current founders and the team to help them be successful in their current work, to help them achieve an increase in enterprise value by sharing the combination of wisdom and work that our board and advisors have, and to be there as good partners. Candidly stating, we don't want their jobs. They're the right people in the right seats, but we're there to support them. Mm-hmm. And we have this empathy for that, being founders and operators ourselves.
How is it different than kind of a growth stage investment fund?
Well, the most important thing with a SPAC is when you combine, you're a publicly traded company. You have the ability to communicate with your shareholders. You have to be in compliance with federal securities laws. You will be submitting your quarterly financials. We encourage good following by Wall Street analysts so that investors have an understanding of what's going on in your business. We also encourage long-term fundamental investors to be part of the investor group, to be there to support the company through its growth stages. And there's also the opportunity for liquidity, quite different to just going through to taking another investment from a later stage fund. Because I do believe the SPAC, the IPO, is a stage in the financing journey, and it eventually comes, particularly with later stage venture.
Yeah, I don't know if it's public, but can you talk about how many capital providers into your SPAC there are?
Well, the large owners of any SPAC do file their ownership stakes or interests with the SEC, and we have double digits numbers. I don't have that exact information available.
Yeah,
it changes every day.
Well, yeah. Okay, so that's interesting. It sounds like it's kind of, at least in my mind, and help me clear up any misunderstandings or discrepancies as we go. But there's an element of like a VC investment, because it seems like this is a route for, or at least in practice, for companies that maybe wouldn't be at a maturity level to support an independent IPO to access public capital markets and all the kind of visibility, transparency that comes along with that. And go ahead if you want to jump in there.
Certainly the obligations of being a public company are the same whether you go public through the traditional IPO or through a direct listing or a SPAC. Those are the table stakes, and compliance is key. What we do offer through a SPACs generally, I think, is a more cleaner, faster, reliable path to going public with a lot more flexibility. And when I look at many of the recent IPOs, including today's, the Snowflake IPO, I have to think about what very prominent venture investors like Bill Gurley have often said about the IPO processes, where they've highlighted and lamented the significant amount of cash left on the table through an IPO. When you see companies go public and have day one pops of 100 or 200%, it makes me wonder why the stock was priced like that in the first place if there was such significant demand. So hopefully through most SPACs you get better pricing accuracy, and insiders and sellers don't think they're leaving too much money on the table.
Yeah. Does that play out in practice? I mean, the noteworthy SPAC deals that have happened, is there meaningful price movement in the publicly traded SPAC units once the deals are done?
The objective, I think, for many in the combination is to ensure that the pricing is fair and accurate. And when the units move, they move because of keen market interest in the overall offering post the sale, as opposed to a significant discount with the objective of getting a first day pop.
Can you talk a little bit, maybe just to kind of round out the SPAC 101 conversation, about the actual combination, or the quote unquote acquisition, and how SPACs generally think about that? Because it's not kind of one-to-one, use our capital to buy a company. There's generally a leverage component, I'm sure, like virtually every private equity type transaction. Can you just talk a little bit about that, and maybe using your SPAC as an example? I think raised $750 million. What would like a target acquisition value be?
We are flexible as far as that's concerned. I do think if we just think about the common math with our trust of 750 and everyone's ability perhaps through a SPAC to also do a PIPE, we'd be looking at a larger size company. I think the size of the business could be in a range north of $1 billion upwards. So there is a lot of flexibility. And Betsy often refers to the SPAC as being an accordion in financing terms. You can stretch it out, or you can contract it in order to find the right deal. It's a very, very flexible model.
I imagine because it's a flexible model, they're kind of flexible, or rather, you would have a bit more flexibility into the type of deal that you might pursue. But is there a natural preference for buy and hold, like an early company that investors expected would have kind of 10 years of continued hockey stick growth, or is it buy something a bit more mature with maybe cash flow? How do the incentives encourage SPAC management teams to think about that?
I think the predictability of future revenues is very important, because there is this emphasis on the forward-looking statements. So I think everybody involved in any SPAC wants to be able to represent to the best of their ability what the future may look like. So if a company doesn't have any revenues today and hasn't launched a product, that's certainly way too early. I'm fascinated by businesses that have a strong foundation today with very loyal customers and are in a position to grow forward. If we're going to make a comparison to early stage venture, whenever I do an early stage deal, I think about the 4 T's: team, tech, TAM, and timing. And while team, tech, and TAM are consistent across any business, timing's very, very critical in the SPAC world, because the company needs to feel ready to be a publicly traded company. That's a cultural element. It's also tells you about the mindset of the owners and operators. Do they want to deal with the requirements of publicly reporting? Do they want to be SOX compliant right now and go through that exercise? Are they ready to comply with the various board regulations which are in place, and to be a member of a national stock exchange? So that's why the timing is quite critical.
If you look at other deals that have been done over the past, I guess, just a couple of years, I think you mentioned some examples of successful SPACs. It feels like it's everything from good blocking and tackling, just SPACs doing what they're supposed to do, buying good companies, maybe some cash flow, and then running them or letting them run public. There are other instances, I think. Nikola, right? Like the kind of Tesla competitor, which seems like it's little more than a concept, was taken public via a SPAC acquisition. And then I believe there was another example, not maybe too long ago, but a couple of years ago now, of a SPAC eventually buying like a minority stake in Virgin Galactic or some sort of frontier technology type company. So not even a full acquisition. Are those examples representations of how much flexibility SPACs have, or is there something else to read into that?
Well, it's I think it is an indication of the flexibility that SPACs can have, and I repeat that analogy or that description of a SPAC being much like an accordion. What music do you want to play with the accordion? And it's subject to the sponsors and organizers of the SPAC, together with the owners and operators of the partner target company, to ensure that the music is one that is pleasing to listen to. In the context of Virgin Galactic, which is a Polytheus SPAC, I think the first one he did. Here you had a very well-known Silicon Valley venture investor, who was probably the first of our types to get into the SPAC space, doing Virgin Galactic. Virgin Galactic was not a Silicon Valley startup by any stretch of the imagination. It was run by Sir Richard Branson and other partners. But I think what Chamath realized is that the SPAC was the right vehicle to bring that company public. It had a big story. There was the ability to get both fundamental investor support, long-term investor support, and retail investors into the deal. And that made sense for them. Other SPACs have gone into deep verticals like real estate and hospitality, travel, insurance sectors, security. We focusing on broader financial services, the intersection of finance and technology. So it's the best way that I've always think about a SPAC is it's an instrument, and call it a musical instrument or a financial instrument. But hopefully everybody likes what they hear at the end of the day.
So if you now VC for years end up sitting across the table from a founder or a founding team, and some of your VC peers who have provided seed A, B, C, whatever it is, stage funding to your potential target company, are they happy to be talking to you as the SPAC CEO? Would they rather be talking to you as like a growth equity investor? Would they rather be talking to you as like an institutional, long only money manager who's traditionally buying on the public markets? Does it benefit them in any way? And maybe it's back to your point about flexibility to sell to a SPAC versus pursue either growth stage funding or an IPO on their own?
Yeah, I would bet that anyone who's talking to me today is firstly talking to me and my partners because they're marginally interested in understanding what we're doing. So there's a bit of a SPAC 101 that goes along with any conversation. Instead of reading it in the newspaper, you can hear it live. Very interested in hearing why we think SPACs are right for their business, so that they can take that feedback and discuss it with their advisors and at their boards, and genuinely intrigued by having another option on the table. There's been an evolution in the financing journey. It's pretty much moving from a one-lane highway to a two-lane highway to now a three-lane highway. And the number of lanes on the highway is going to expand because so the stock exchanges, particularly the New York Stock Exchange and the Nasdaq, are now allowing direct listings together with capital raising at the same time. So that was a stock exchange response to the surge in the SPAC market. And I think first and foremost, we're acting in an educational capacity, and by learning, people will do. So it's we're going to hear a lot of people talking about accordions. I'm sure about that.
Well, we'll know who they're quoting. So then
Betsy
from
Cohen. She takes the credit
Betsy.
for that one.
All right. So then from your standpoint, right, as the CEO and one of the decision makers for this SPAC, how are you thinking about the universe of investment opportunities? What's looking like an attractive place to seek?
Well, the fintech ecosystem has been one that's been very fertile, touching all aspects of payments, savings, credit, wealth management. And I think there's a lot of opportunities in that vertical. There's also a number of opportunities to look horizontally in that vertical, to think about all the enabling technologies that have made the financial services industry grow and thrive, but also service other industries, ranging from security to database management and CRM, just as some examples. And it's our job to look at a number of opportunities and to assess them from the perspective of, is it the right fit for a SPAC like ours? Starting with the people, looking at the technology, just putting a lot of emphasis into what the market is about in underwriting, and then considering the timing question: is it the right thing? And it's much like venture capital in that regard, because we have an opportunity, we have a 2-year window to review a significant amount of opportunities, get to know the people, and be sure that the fit is the right one for the time. It's very, very exciting to be in this space. And it's also exciting to be amongst the first from the venture community, and particularly the Bay Area technology and fintech community, and to be involved in the space. I think there are going to be many, many SPACs that get IPO'd in the next couple of months by folks who we know well from the Bay Area and from other technology centers. I think we're going to see SPACs go public globally. The first SPAC got filed in London today by a very well-known SPAC originator from the United States. I know that in Southeast Asia and other global markets, the stock exchanges are looking at the SPAC world themselves as well. But I say for the foreseeable future, the United States will be the SPAC leader, and hopefully we'll see great results to support the leadership position.
Mm-hmm. Is there anything about right now, COVID times or whatever it is, that might be driving any of this interest in SPACs? I mean, does it have anything to do with fundraising environment, with road shows, with on down the list?
The fundraising environment changed overnight. We went through our process with about 46 hours of Zoom calls. That's a lot of Zoom time. But it certainly was preferable if we were to compare what we have done outside of the pandemic, flying around the country and having a process that would have taken a lot longer. We were able to cram these calls in to about a week and a half. It's impossible to have achieved the same reach and education in an in-person environment. I don't think that that SPACs in particular have been benefited by this. What I do think has driven a lot of interest in SPACs is the popularization of the opportunity based on proven success. The corporate operators and founders and investors, hedge fund investors, fundamental investors, as well as a broad range of sponsors, have seen the work that people like Betsy Cohen have done in the past. And they've recognized that the pace has been set. They also believe in their capabilities and feel, well, if Ryan Gilbert can do this, so can I. And I think that's great. We've given folks something to reach for, and I think there are going to be many, many successful ones, because you don't need to be a Nobel physicist to get SPACs operating, but you do have to have respect for the process, respect for the law, and most importantly, respect for the people involved. The process of running a SPAC, leading a SPAC, and going through the de-SPAC process is all about listening and having deep respect for everyone involved.
So if one of your Propel portfolio companies called you up and said, hey Ryan, we got approached by a SPAC. Now, I'm sure you would start by saying, we should talk because oh, by the way, I have one. But that aside, like what questions would you suggest they ask to the SPAC management team? How would you advise a potential acquisition to interact with the SPAC versus potential other providers of capital?
I would say first and foremost, get to know the team. It is the human capital part of venture capital, where the early stage or late stage that matters. Secondly, understand the structure of the SPAC. All SPACs are publicly traded. You're able to go to the SEC website and pull all the filing documents and get good counsel to explain to you how the SPAC works and operates. Ensure alignment with the SPAC sponsors and management team about what the goals of the combined company would be, and understand your role in that combination. And then ask the question, are you ready to be a publicly traded company?
So you talk about the roles of the sponsors, SPAC management team, and entrepreneurs or management of the target. Can you just unpack that a little bit? I mean, do the SPAC managers stay after the tie-up, or do they just kind of go away and it's as if the acquired company is just a independently listed company?
Post combination, in most circumstances, the partner target's management team continues to run the business because that's what they want to do and that's what we'd like them to do. Where appropriate, the team will be supplemented and enhanced with new members that we could help recruit in. Sometimes there are additions to a board of directors, but the SPAC management team or the sponsor team that exists pre-combination is not involved largely in the day-to-day operations of the business. The role of the team becomes one of an investor in the business for a long term.
Got it. And did you say before that the structure, like the incentive structure for your SPAC specifically, was one that you expected to drive good long-term results rather than kind of opportunistic short-termism?
It certainly is common will for modern SPACs to ensure that the earnout tied to the sponsor promote is tied to the results. And with a publicly traded company, the stock price is often the best mirror of results. So as that price goes up, more and more sponsor promote vests. And the recent IPOs, particularly those driven by those of us from the venture community, have all taken different approaches to achieving the same outcome. Long-term partnership, ability to monetize when results are achieved. And that's really what alignment is all about.
In a traditional IPO, you will know infinitely more about this than me, but there are lockups for founders, for employee shareholders, for investor shareholders post IPO. Do the same sorts of lockups or any similar lockups exist post SPAC acquisition?
Yes, the same lockups do exist. These are SEC related lockups, and in certain instances there could be lockups that get agreed by the various parties to the transaction in order to ensure commitment of all parties across the board. Yeah, nothing different in that regard.
All right, Ryan. So we've covered a lot of material there, and I think we've ticked through a lot of the things that I was hoping to get a little insight into. Last question I have for you is more of a personal one. How do you manage all this? Continuing to lead Propel and now CEO of the SPAC. I would imagine there's some interesting potential overlaps between the two.
I'm certainly excited by the overlap of opportunity and networks from my role as a founder and early stage investor through to my role in the SPAC world. So many of the men and women that I've been able to partner with and work with over the years are now running very exciting, substantial companies in the broader financial services space. They've grown, I've grown, and I think together we're ready to take the companies public. So it's a natural evolution, both of our careers and our companies, that we are here today. And the fact that we all know each other so well, I think will make for some very, very interesting deals. In my work the past couple of weeks, the reach outs that we've had with insiders and the operators haven't had to be facilitated by any outsiders. This is a matter of emailing or picking up the phone to have a conversation with people that we know well, that we used to hang out with at Money 2020 and other conferences that aren't happening this year. But at least the SPAC conversation gives us reason to get on a Zoom and have another chat.
There you go. Well, I'm sure there are plenty of people in your network who would be more than happy to sell you a company for more than $1.5 billion.
I look forward to meeting them, Will, and send them our way and let them know that SPAC isn't a 4-letter word, but it's a very interesting financing instrument on the journey of a venture-backed company.
Excellent. Ryan, great to connect. Thanks for all the insight. Super interesting. Ryan Gilbert, thank you very much for joining us today.
My pleasure, always. Thank you so much.
Thanks for tuning in to Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.